Very good morning, everyone. This is Professor Shyam from LJ Integrated MBA 5-year program. We will be talking about the basics of financial risk management in this video. So, without wasting time, let us start. We make hundreds of decisions on daily basis, and in every decision that we make, there is always certain amount of risks involved. Right? This can be simpler decisions such as whether to carry an umbrella or not because it might rain, or it can be taking decisions, right, which are complex in nature, such as which shares to invest in, what are the sectors that are looking promising in the future time period, right? All of these decisions and the risks that are attached to the same give us an insight on the basic form of risk management, right? Just as we individuals have to take decisions in our daily lives, businesses and financial institutions also have to manage their risks in order to prevent from huge losses or to sustain in the market, right, for a longer time period. This gives birth to the concept of financial risk management, where businesses and financial institutions, right, manage their risk so as to prevent financial losses due to abrupt changes in market conditions, changes in credit conditions, or any other operational failures that might happen in future. So now let us move forward to the concept of risk. Well, the thing that is surprising is that there is no single definition of risks. Whereas a risk has been historically defined in the terms of uncertainty, right? While these two terms look identical, they are very different when it comes to the reality, right? Most of the people are not able to understand the concept of risk and uncertainty. To define risk in simplest word, risk is the potential for loss. The potential of loss, right, is something which can be called as risk. Risk can also be defined as the probability of a bad thing happening or a good thing not happening. But when it comes to the concept of uncertainty, it is something which is very typical in nature. So what is uncertainty? Uncertainty can be defined as the absence of certainty, right? Something which is unknown, something which can happen anytime can be considered as an uncertainty. Now, let us understand the concept of risk and uncertainty in detail. The biggest fundamental difference of risk and uncertainty is risk can be predicted. Yes, the degree to which risk can be predicted is unknown. Yes, risk cannot be predicted 100%, but yes, there is some predictability when it comes to risk. Why? When it comes to uncertainty, it cannot be predicted. And the fundamental is very simple. What can be predicted can be also managed. While uncertainty is something which cannot be predicted, it can happen anytime, right? Someone may face an accident tomorrow. I might be bitten by a dog, right? So what can be predicted can be managed, but uncertainty is unpredictable because you cannot predict what is not certain. Since risk can be predicted, it can be managed. Uncertainty, which can happen anytime. A good event may happen, a bad event may also happen, but there is no certainty. So it cannot be managed, and hence it can only be insured. Whatever can be managed needs to be quantified. But when it comes to uncertainty, it is always qualitative in nature. Right? Since the risk can be managed, we can quantify it. But uncertainty is behind the curtains. It cannot be known. It is always carrying a surprise element with the same, and hence it is always qualitative in nature. Risk can be measured in terms of probability, whereas uncertainty can only be known by its possibility. An event may be possible, but if you cannot measure it in the terms of probability, it remains as an uncertainty. So what Donald Trump will do in the next course of time period is unknown. So that remains an uncertainty. And financial markets in general do not like uncertainty. They want a clear, visible path as to how companies are going to be managed, right? So financial markets have a disliking for uncertainty, and uncertainty is one of the biggest reasons why companies, financial markets do not perform as they should be performing. So now let us move forward to the concept of loss. Right? Just as we saw in the definition of risk, there is no particular definition of risk. The same thing is carried forward over here. There is no particular definition of a loss. Loss in accounting sense means the portion of expired cost for which no compensating value has been received. Say, for example, I purchased apples for 100 rupees per kilogram. If I have to sell those apples for 90 rupees per kilogram, I am not recovering the cost. Right? So that is my loss. Say, for example, I manufactured a bicycle worth rupees 80,000. Now, my cost price is 80,000. If I have to sell that bike for 75,000, I am not recovering a portion of the cost that I have incurred. And that also becomes my loss. Loss can also referred to as an act or instance of losing the detriment or disadvantage resulting from losing, right? If I am using my mobile phone and my mobile phone suddenly stops working, then it is also a loss. Loss means being without something you previously possessed. Right? If my wallet gets lost, it is also a loss for me because I had my wallet with me. And now, since it is lost, I do not possess that wallet. Now, let us look at the meaning of perils. In simplest words, peril means, or peril can be defined as the cause of loss. Right? It means the immediate danger a person or any institution or an organization is facing. Say, for example, that I am driving a car and my car gets collided with another car on a highway. Then the cause of loss to my car, the cause of damage to my car is an accident. If someone's house is destroyed because of fire, then the peril can be fire. The cause of loss is fire. Right? Common examples of perils are theft, burglary, flood, earthquake, natural calamities, and all that instances. So now let us move forward to the concept of hazard. A hazard is a condition that creates or increases the frequency or severity of loss. Right? Summers can be considered as an hazard because it increases the severity of fire. We know that when it comes to summers, we already face a high temperature, and this increases the possibility that fire may occur. So in summers, right, we have a higher chance of getting into a fire. It can be electrical fire or it can be caused due to natural calamity. But summers is an hazard because it either increases the frequency or the severity of loss. Right? There are three types of hazards. The first one is physical hazard. A physical hazard is a condition that increases the frequency or severity of loss. So if I am driving on icy roads, right, there is an increased probability that I might have to face an accident. This is because the roads are not in a condition to facilitate smooth driving. So that becomes a physical hazard, right? The second one is moral hazard. Moral hazard is inherently qualitative in nature, where there are defects in my character or I am not disclosing the right information to someone who requires it. So say for example, that what people usually do is they do not disclose the habits that a person has when they want to purchase an insurance. People might be smoking, they might be drinking, they might be consuming tobacco, or they might have some or other type of bad habit that adversely affects their health. And in order to pay lesser amount in premium, they do not disclose this information with the insurance company. Now, what happens is the insurance company might reject the claim, or it might also result in a deduction of your claim. This is where moral hazard comes into the picture. There has been many instances where people fake car accidents or people fake fire in their godown or warehouse just to collect insurance. While a fake accident or a fake fire might result in a claim for me, right? I might receive claim money, but that inherently results in a loss for insurance company, which is a problematic thing. The third one is legal hazard. Legal hazard refers to the characteristics of legal system or regulatory environment that increases the frequency or severity of loss. Right? Say, for example, that I have skipped a traffic signal and I am being fined 500 rupees. Next week, I skipped the traffic signal for 2 times and I am still paying 500 rupees as penalty. Now, this is a legal hazard. Why? Because it is not driving me. It is not preventing me from skipping my traffic signal. If you want to stop traffic signal skipping, what needs to be done is the amount of penalties need to go higher and higher as and when you skip a traffic signal. So if I'm skipping the traffic signal for the first time, I might be fined 500 rupees. If I am skipping the traffic signal for the 5th time, I may have to face a penalty of 5,000 rupees. And if I am skipping the traffic signal for 20th time, it can also result into suspension of my driving license. Legal hazards are one of the most important issues in a developing country. We will now look at financial risk in detail. What is financial risk? There are 3 inherent elements in a financial risk. The first one is someone is adversely affected, right? So if someone faces a car accident, the person is adversely affected. Second, the assets or income are exposed to financial loss. So if a person meets a car accident, their car might suffer damages. This is being exposed to financial loss. The person might also be physically injured. So that is also a financial loss. It might also have an impact on its income earning capacity. And the third, the peril can cause the loss, right? There is always a danger that something may happen which will also result into loss. Now we move forward to the Final topic, non-financial risk. When the possibility of financial risk doesn't exist, the situation can be referred as non-financial in nature. The most common examples are culture or conduct risk. Say, for example, that Mr. ABC is not conducting himself properly at his home. He is not behaving properly with his parents. That might not result into a financial loss, but yes, he is also facing some risk. If a person is behaving badly with their co-workers or colleagues, this is an example of non-financial risk. In our daily life, financial risks matter more and they are more particular in their nature and because of its ability to create losses. We will be meeting in the next video and we will carry forward the basics of financial risk management in the next video. Thank you for watching. Have a nice day.